Two brothers, same career, same house, same life, except one silently hands over an extra $250,000 to banks and landlords, all because a 3-digit score says so. The modern credit system promises fairness, but in reality, it is a ruthless profit engine born in 1989 and now deciding who pays and who gets paid. But how did an algorithm younger than Taylor Swift start siphoning your future? The answer begins with the twins. Mark and Dave are identical in almost every way. They grew up in the same house, landed the same $75,000 salary, and even drive the same grey sedan. But over the course of their adult lives, one number quietly splits their paths. Mark's credit score sits at 760. Dave's is stuck at 640. That single difference, 120 points, becomes a financial siphon that never stops draining. When Mark buys a $400,000 home, he locks in a 6% mortgage rate. Dave, flagged as a risk by the algorithm, gets saddled with 7.5%. The result? Dave hands over an extra $120,000 in interest to the bank for the same house on the same street. Every car Dave finances costs him thousands more in interest. His credit cards come with higher rates and lower limits. Insurance companies tack on extra fees year after year, sometimes charging more for a low score than for a DUI. Landlords demand bigger deposits. By the time retirement rolls around, Dave has paid out an extra $250,000 for nothing but a number. The system does not care that the twins are equally responsible, it only cares which one is more profitable to lenders and insurers. That is the hidden tax of the credit score. Relentless, silent, and entirely legal. Mark and Dave's story is not rare, it is the business model. In 1989, a new gatekeeper arrived in American finance. The FICO score, developed by engineer Bill Fair and mathematician Earl Isaac, replaced the old world of handshake deals and personal judgment with a cold, automated number. For over a century, banks and lenders had relied on human underwriters, often letting bias and gut instinct decide who got approved and who was left out. FICO promised something different, a single score calculated from the raw data in your credit report with no room for negotiation or second chances. The system sorted every applicant into neat categories, prime or subprime, worthy or risky, using nothing but a formula. This was not just a new tool, it was a new social order. Mortgage lenders, credit card companies, and car dealerships could now make decisions in seconds, not days, and they did not have to explain themselves. By 1995, Fannie Mae and Freddie Mac required FICO scores for every conforming mortgage in the country. Within a decade, 3/4 of all loan approvals ran through this algorithm. The promise was objectivity, but the reality was a new kind of sorting. The FICO score did not measure wealth, honesty, or even stability. It measured how profitable you might be to the banking system. If you landed above 760, you joined the prime class, with access to the best rates and lowest fees. Fall below 640 and you were branded subprime, locked into a cycle of higher cost and suspicion. The score did not just predict your future, it quietly decided it. A 1.5% difference in mortgage rates might sound minor, but over a 30-year loan, it quietly becomes a financial wrecking ball. Let's break it down. On a $400,000 home, Mark's 760 credit score secures him a 6% fixed rate. His monthly payment lands around $2,398. Dave, with a 640 score, gets a 7.5% rate for the exact same house. His monthly payment jumps to about $2,798. That is $400 more every single month just to satisfy the algorithm's risk appetite. Stretch those payments over 3 decades. Mark pays roughly $463,000 in interest. Dave hands over $607,000. The penalty for a lower score is nearly $144,000 lost to the bank, with nothing extra to show for it. And that is before considering what that money could have done elsewhere. If Dave had invested that $400 difference every month, earning a modest return, it could have grown to over $500,000 by retirement. Instead, it evaporates, an invisible tax enforced by a number that never sleeps, This is the true cost of a subprime label. It is not just a higher payment, it is decades of lost opportunity, quietly compounding in the bank's favour. A 3-digit number now decides where you live, what you drive, and even how much you pay to stay insured. Most landlords run credit checks before handing over a key. Employers screen applicants with background reports that quietly include credit data. Insurance companies have taken this system to a new level. In many states, a driver with a recent DUI conviction and excellent credit can pay less for car insurance than someone with a spotless record but a low score. The math behind this is not about morality, it is about actuarial tables and profit. Insurers claim that credit scores predict who will file claims, sometimes more accurately than driving history itself. This logic runs deep. The algorithm rewards what it calls responsible borrowing, but the real prize goes to those who keep balances circulating. Pay off a loan early and your score can actually drop. Use cash for everything and the system treats you like a ghost. The more you churn debt without defaulting, the more the algorithm smiles. High utilization looks risky, but a little debt, always paid and never cleared, signals profit to the machine. No one escapes this reach. Whether you're applying for a job, renting an apartment, or renewing insurance, the score stands between you and the best rates. The rules are set, the incentives are baked in, and the only way to win is to play the game on the system's terms. Credit scoring isn't about how much you owe, it's about how you look on paper. The fastest lever in the system is your credit utilization. This one number makes up nearly 1/3 of your entire score. Here is how the game works. If you have a $1,000 limit and carry a $900 balance, the algorithm sees a red flag. But if your limit jumps to $10,000 and you still only used $900, you look like a model borrower, even if nothing else changes. The trick is to keep your utilization under 10%. That means calling your bank every 6 months and asking for a limit increase. No new hard inquiry, just a bigger buffer. Most banks say yes, especially if you have never missed a payment. The result is simple. Your score climbs not because you paid off debt, but because you changed the optics. The algorithm rewards the illusion of unused credit. That is the first step. Make the system see what it wants to see. There is a shortcut that flips the score in your favour almost overnight. It's called the authorized user hack. When someone with a long, spotless credit history, often a parent, adds you as an authorized user on their card, their entire payment record gets pasted onto your report. You do not even have to touch the card. Suddenly, an 18-year-old can unlock 0% interest rates and prime credit cards just by borrowing someone else's history. That is not a loophole, it is baked right into the system and banks know it. But the real power comes from understanding your legal rights. The Fair Credit Reporting Act gives you the right to dispute any error on your credit report. If a bureau cannot verify a negative mark within 30 days, they have to remove it, no questions asked. Aggressive disputes have wiped bankruptcies, collections, and missed payments from millions of files. And here is the golden rule: never close your oldest credit card. Even if it is collecting dust, that ancient account anchors your credit history. Buy a pack of gum once a year, keep it alive, and let the years do the work. These are not tricks, they are the rules of the game. Play them right and you stop paying the poverty premium permanently. Right now, a private algorithm decides who pays more and who gets the keys. As credit scores expand into hiring and insurance, the line between financial access and financial exile sharpens. The score is not going away. Knowing the rules is not just smart, it is survival. Share your thoughts below.